Well, welcome to Investor in the Family Radio. This is Brian Bain, your host. And again, joining us today is David Reyes. David, welcome back to the show.
Hey, it's good to be back. Thanks for having me back.
As always, and we're continuing our series going through the Berkshire Hathaway letters to shareholders. And right now we're going through the 1970s. And today we're doing the 1976 letter. Again, these are Warren Buffett's letters that he's wrote to the shareholders of Berkshire Hathaway. Started way back in 1965. We're planning on working our way all the way up to modern day times, which is really exciting. And if you're just joining us, it's been a really neat process to see how did Warren Buffett build his business. And that's the whole thing we're focusing on is how did he build his business? And that kind of works into one of our big themes here at Investor in the Family is that our household, we should consider our own households as a business venture. And when it comes to our investments, we should view them as any business that has extra capital. How do they want to allocate that capital to then bring the best return over time? And really, and again, and that may sound like common sense to some people, may sound radically new to some people, but that's basically how Warren Buffett built his business. He had a business, textile company of Berkshire Hathaway, and as that business made money or had extra money, they decided, okay, what do we want to do with this? And the story of these letters is how do they manage that core business and how do they use extra money to buy new businesses, start new businesses, and manage those businesses. And so that's what we're doing here today. And again, we're in the 1976 letter, and I'm joined by my esteemed colleague, David Reyes. And again, if you want to see any of our older podcasts or any other updates with Investor in the Family, you can always go to investorinthefamily.com. But today, we're going to dive into the letter. You ready, David?
I am ready because I think this letter might be my favorite letter of all, actually.
Wow.
So far.
All right.
So far. I mean, because I feel like we're getting into some topics that some questions that I've had for the last couple of podcasts, and I feel like we're getting close to answering these. And so I'm excited about it.
Well, I'm excited to hear that too, because we as always, we're chatting a little bit beforehand. And I mean, David, do you mind sharing a little bit about kind of what you shared before we started recording as far as what your experience with these letters has been? Because again, for people listening, David's coming in to this show with not really any investing background at all, which is one of the reasons why I wanted him on here, because it's a great learning experience for him, but it creates a great dynamic for listeners as well, whether you have more experience like me or no experience like David, to really figure out how to get the most out of these letters and make it the best learning experience possible. So do you mind sharing a little bit about what reading these letters has been like for you so far?
Yeah, well, it's been kind of like, I mean, I try to every week, I feel like you're pulling things out that I'm like, oh yeah, that is true. I'm like, how did I not see those things, those principles? But I do think that's what it is, just coming in with really no background, and kind of some of this stuff. For a while, it's just been like, okay, cool. He's just doing some reports and just kind of categorically going through all of his different investment opportunities from the textiles, insurance, banking, you're kind of looking through all this stuff. But I feel like every year that we've gone through this, and I've just been kind of going year by year, kind of getting into it, and it's like, okay, I'm seeing, letters are getting a little longer now. There's more companies going on, and so I feel like I see some trends, and so I think that those are some kind of the things that I'm noticing is just like, me coming in with no background, I'm starting to sense just at least some of the obvious trends, and so I think that's kind of been good for me coming in, is just noticing that there are things that they learn from the past and they try to do differently, and they're trying to think through everything like that. So that's been really helpful for me to see.
Well, and it's good to remember that too, because it's completely normal for someone without much background, either with investing or business, to come in and think, this just sounds like some dude talking about his company and it doesn't sound very interesting. You know what I mean? Yeah. Because if you don't have that background and context, there's just a lot of things you're not going to see. But again, the more you come through it, and like if you come back and read these letters in 5 years, you'll probably be like, whoa, I had never noticed this when I read that before. And that's just the way things work,
That's true.
And I will say too that if you go back to the 65 letter and some of those earlier ones, up to the 76 letter where we are here today, this week, I mean, there has been a big change. Some of those initial ones were much more, hey, here are the operations of the business, and if you've got, again, a little bit more of a context for it, you can kind of see behind the scenes and realize, oh, wow, look at the decisions they're making here or how they're handling that situation, and can glean a lot from it. But now we're getting to a point where there's not really as much digging needed. There's some just very explicit stuff shared that's like, oh, wow, that's really interesting and helpful. And one of the things I thought today, we've kind of prefaced this in previous weeks a little bit, has been, and you asked the question actually, how did Warren Buffett make investing decisions? Like, what do you look for in terms of what he wants to buy, in terms of investments? And we get into that in the 76 letters, so I'm excited about that too.
Yeah, because you always just coming from the outside in, you always kind of wonder, okay, you got this money and you get to a point where you're like, okay, I want to invest it in. And my question would then be, I mean, obviously for you and others that have been investing for a long time, you probably build up, your own rubric for how you do things. But in my mind, I'm thinking, okay, I want to find the latest and greatest. When when I hear about investing, it's always something like, cool, like that sounds vague, but like when I hear about like people investing, it's like they're investing in like some really neat thing that's going to hopefully be the next greatest thing that's going to give me more return and all this stuff. And so I don't really think about you got to make a really informed decision about, how you invest your money and things like that. So what do you look for? So I'm interested to kind of dial into some of his rubric on that stuff.
Man, and you may not realize it, but you actually just brought up a really profound point in the fact that most, even as effectively a non-investor at this stage, almost everything you hear about investing is always about the latest and greatest exciting thing that's going to change the world and be all that kind of stuff. The next Amazon or Apple or Google or however you want to describe it. And it's funny because that's true. And that's really true for a lot of us because that's what's exciting. That's what gets people to turn their heads and look and read an article, pay for a report, so on and so forth. But in reality, that usually is like one of the worst ways to invest. because, one of the Berkshire Hathaway way or the Warren Buffett way typically is the opposite of that. Hey, I'm not looking for exciting. I'm not looking for fast. I'm looking for powerful compounding growth over time. And he actually gets in that a little bit this week. And in the next few weeks, we'll get into that a little bit more as he really, for the first time, I think in these letters, starts talking about what goes into them making an investing decision and what doesn't. And he specifically talks about, we're not really concerned with exciting price movement in the near term, which is kind of what you're talking about. People are saying, hey, buy, I'm going to date myself a little bit, but depending on when people listen to this podcast, buy this 3D printing stock or this artificial intelligence company or robotics company or whatever else, because that's exciting and hot. And those could end up being really great investments over time. But usually those are there's a lot of coverage on those companies, a lot of enthusiasm around those companies. Or a great one right now is Tesla. Nothing against Tesla, the company or that kind of stuff. But from a business perspective, it's a terrible investment right now. Doesn't mean it couldn't be great down the road, but right now there's so much excitement around Tesla and Elon Musk that, of course, right now it's fading a little bit. But over the previous years, it's been a really big deal. People are super excited, so the price is really, really high. But people think, well, yeah, it's quote unquote overvalued right now. But wait till things start working. Eventually, it's going to get even more valuable. And that's that example of an exciting opportunity that in reality, from a business perspective, is like, you know what? This is a terrible investment. And here's the thing is, some of those will end up doing well. And in some cases, people who invest today when it seems really overvalued will still do really well over time. And so maybe you'll miss out on a few of those opportunities, but for the most part, those don't work out well. And then the other mindset is kind of like a Warren Buffett mindset of like, hey, where can I find something that's really undervalued and kind of even hated or disliked, but still really valuable?
In your opinion, in the investing world, do you feel like, and obviously, I mean, there might be to an extent because we're reading this letter, but do you feel like history repeats itself when it comes to investing? In the trends that you've seen, in the things that you've seen Warren Buffett say, do you feel like a big factor that you could use to make decisions is based on history of companies and the way the market's gone, things like that?
Yes. And let me explain what I mean by that, because primarily history in terms of investor behavior around certain market events. Because sure, I mean, you can look back the 20s, the 50s, the 70s, the 90s, and today and see obviously a really different world and really different companies And if you look at the top companies of each of those decades, you think, well, I've never even heard of that company before. And that was like the biggest company in the world at that point or something like that. And you're like, what is this place? And so things change significantly, but people don't. And typically what you'll see is over and over again is the primary things that cause individual investors or any investor to fail, a professional or a quote unquote retail investor, DIY investor to fail. It always comes down to the same stuff. And it comes down to emotions, which is so boring to hear that because anyone who's been investing for any period of time has said that before and heard that before. And it's like, okay, I'm tired of hearing it, but we have to hear it over and over again because we're so emotionally driven. And there's that idea that the average DIY investor continues to buy high and sell low because you buy into excitement, like we talked about, and sell into fear. When you should be doing the opposite. I mean, honestly, it really is that simple. Obviously, there are dynamics to make it complicated. It's in terms of knowing, okay, well, when is something hated and unpopular, but still worthwhile? Because there's some things that are hated and unpopular that go bankrupt, and some things that are hated and unpopular that are really great businesses, but just people aren't paying attention right now.
Yeah, that's true. Yeah, so, it is interesting, and I'm excited to kind of, like we talked about, just to kind of get into what Warren Buffett talks about in the letter about, like, kind of how he, decides on investment opportunities.
Well, and there's some investments that are always super boring investments and not exciting, but when you look at it over a period of years and decades, are some of the best investment opportunities available because something that makes 15% returns per year on average, it's not going to make 15% every year, but on average over a decade after decade is 15%. That is an incredible investment. But, in the short term, it could look super boring. It could be like just sort of some random insurance company or a home building company or something like that. Where you think, why would I care about that? When there's this great Tesla company over here that's super exciting, is going to change the world, or Amazon or whatever else. And Amazon is absolutely astounding business, but that doesn't mean it's necessarily the best investment right now either. Right. So those things, are significant. And also people tend to not care about dividends. I fall into that trap as well. And just a dividend is basically, a company makes a certain amount of money in the year, and after all their expenses, they've got money left over, and they have the opportunity to either put that money back in the company to reinvest it, or invest it outside the company somewhere, or give it back to shareholders. And a dividend is when they give money back to shareholders. And typically it's like, that's really boring. You say, okay, this company is paying 35 cents per share, like, ooh, thanks, But when you look at the overall returns on the S&P 500, which is like an index of the kind of some of the biggest companies in the U.S. stock market, over 40% of the returns historically usually come from dividends. That's a big deal. Yeah. And over time, they add up significantly. And the fact that usually a company that can pay dividends is a company that's really healthy. It's something else that people don't really pay attention to enough. That's a significant dynamic. And there's some sectors that are really cyclical that, they just always go through boom and bust periods. Like oil and energy companies are like that. Every certain number of years, there's usually going to be a big run up in oil prices and then a big sell off. And, if you catch it at the right time, it can be really lucrative. But then again, the perfect timing is there's never a letter that shows up in the mail saying, hey, here's the time to sell and here's the time to buy. And so, there's a lot of those dynamics that do repeat to be mindful of. So the thing we want to focus on in today's letter, like you and I discussed earlier, is really for the first time, Buffett actually talks about the companies the public companies they are invested in through Berkshire Hathaway. Usually in all the letters he goes through and talks about, okay, here are the companies that we own, like outright. Like we own this company, they're privately held companies, we own them. And he does that throughout this letter as well. But he actually goes through and talks about, here are the individual public companies, stocks they own, and talks about the reasoning and thought process behind their overall public investment strategy, which is obviously super applicable to us. But before I mention that, I'm going to mention something we've said a bunch of times, and I want to continue to reinforce over and over again. It's how much energy and focus Warren Buffett places on highlighting his managers. Like he has all these companies he owns, the textile companies, the insurance companies, the banking companies, and so on. And he is so diligent to, by name, mention the managers of these companies and praise them for the great jobs they're doing, even if the company is struggling in some way or another. And the reason I want to highlight that is, as investors, twofold. First of all, it's so important that we invest our money in companies that have great management, because great management will be able to make great decisions even if the company is struggling, even if the industry is having issues, and great management will limit losses and find ways to get gains when other people couldn't. Think of it like coaches. You have whether you like college football or whatever else your sport may be, I always say that a great coach can make a bad team good and a good team great. And a bad coach can make a great team bad. And same as with management for companies, and that cannot be overlooked. And clearly it's a huge part of Buffett's investing strategy that comes out with his privately held companies, and we'll see that again in a moment with the publicly held companies. That's one reason why I want to highlight it for us. The other reason I want to highlight that for us is that we want to, as individual investors, we have to have help. And the way I look at this is when I pay for a newsletter or buy research or tools, that is me hiring a manager to guide my investment strategies. And once I hire a manager, I need to trust that person. Warren Buffett hires these guys and he trusts them. That doesn't mean he gets their feedback. I'm sure he has conversations with them, but then he lets them run the business. And as individual investors, I'm a big believer we need to do the same thing. If I pay $100 a month or $1,000 a year or whatever it may be for an investment newsletter, I need to trust that person to do the work and follow their work, because I mean, either that or I either need to stop paying them or I need to trust them, if that makes sense. So
yeah, and I feel like it's people that are going to get you. They're playing the long game. It's kind of like it's really easy to, again, it's just like buying into Tesla. It's buying into things that are just exciting and stuff like that. It's really easy for someone to kind of be successful when things are really exciting and stuff like that. But I think kind of a good principle behind kind of the point you're making, it's just kind of neat to see like the even when a company's struggling, he's still with them, but it's really kind of similar to just people that can play the long game, people that are in it for not just a bad year, but they're in it for, the building up of something. So,
well, and realizing that almost any great investment manager, whether it be private equity or hedge fund or whatever else, everyone has seasons that are down a little bit. A couple of years, maybe they lose money or don't do great or whatever else. That's just normal. But over time, those people outperform and do fantastic. And I actually read a great article about that recently, where basically it's expressed that exact same idea, where the top managers over a 1 decade period of time, like every one of them had a 2 or 3 year period where they're like almost at the bottom of that group, but over the overall period they were at the top. Then just realizing if you come in at one point, or if you toss them out because of a couple of bad years, you're the one who's losing, if that makes sense. So
yeah, that is interesting.
Well, okay, let me jump into again this portion of the letter where Buffett really for the first time starts talking about his individual stock investments and kind of their mindset behind picking those companies. Warning, it's probably going to sound really boring, but if you're smart, you realize this is life-changing information, and if we're willing to apply it to ourselves. And so that's why I'm stoked about it. So here at the beginning, he talks a little bit about bond prices, which I'm not going to spend a lot of time about that, except for the fact that he says they have a lot of unrealized gains in their bond portfolios. And unrealized gain means basically like if you buy an asset for $100 and then it ends up being worth $125 later on, that's unrealized until you sell it. Once you sell that asset, then you get to realize the gain on it, if that makes sense. So the phrase paper gains can be used as well. So again, if I buy a stock and it goes up a bunch, but I don't sell it, yeah, I've got gains on paper, but until I realize it, like I could still lose those. Those could go away. So it says this too, meaning his unrealized gains, is of minor importance since our intention is to hold a large portion of our bonds to maturity. And again, his point is like, I don't care if we have unrealized gains right now or unrealized losses, because we're going to hold these bonds until maturity either way. The point is, short-term price going up and down doesn't matter to us. And then we'll fast forward to his stock or equity positions where he reinforces that even more. Let's see. He says that we now have a substantial unrealized gain in our stock portfolio as compared to a substantial unrealized loss several years ago. So it's like a few years ago, our stock portfolio was losing money. Now it's making a lot of money. But it says here again, we consider such market fluctuations from year to year relatively unimportant. Translation, don't watch the stock market. Don't watch your portfolio. Don't look at prices on a daily basis on your phone going up and down. Again, you need to check in periodically, but watching day to day, it just messes with us and makes us think, oh, it's going up. Oh, it's going down. Should I do something? And typically speaking, the least active we can be to bet, the better. Not always, but generally speaking. He says, we consider such market fluctuations from year to year relatively unimportant. Unrealized. Oh, then he talks about specific numbers, which we don't need to get into. The next paragraph. However, we consider the yearly business progress of the big companies in which we own stocks to be very important. So saying, hey, we don't care what the stock price is. We do care about what the business is doing. Which is the opposite of what most investors do. Most investors watch the stock price and don't look at the business underneath. We don't read the annual reports. We don't listen to or read quarterly earnings calls with management and things like that because it takes time. It's harder. It's the way you described reading these letters. Sometimes they're boring. Sometimes we don't understand what's going on. And so therefore we just skip it and we find something else that's more exciting basically. And Buffett's saying we do the opposite of that. And then he goes, and here we have been delighted by the 1976 business performance achieved by most of our portfolio companies. If the business results continue excellent over a period of years, we are certain eventually to achieve good financial results from our stock holdings, regardless of wide year-to-year fluctuations in market values. Translation, if the business is performing well, making good decisions and seeing good results, eventually the stock price will follow. That's what he's saying. And again, that doesn't sound so revolutionary.
Crazy.
It sounds super obvious.
Yeah, I'm kind of the same way. I'm thinking like, man, that's like, again, you keep saying it's opposite of what the norm is. It's opposite of what it is. And it's very like, this is kind of a very rational approach, but a lot of times like our money speaks more, for us that rather than like I guess the way I'm sensing it is Warren Buffett's really just explaining how he's really looking at things from a more rational frame point and just kind of thinking, again, the long game, as opposed to, hey, this is where my money can succeed right now.
Right.
And he's investing in people is what it really sounds like then first. And then the company, is that what I'm getting at?
Well,
kind of just investing in the business side of things.
Well, and actually when you hear about venture capital, or like, basically venture capital is the area of investing where people have, it's not publicly traded companies, but say like Silicon Valley startups or new tech startup that's, like you said earlier, going to be like the newest, biggest, great thing. Venture capital is usually, or like angel investors are the people who will give money to those companies early on to get them started and help them grow. Kind of like you're seeing on Shark Tank, for example, but usually on a much bigger scale. And usually what you'll hear the mindset is people say, hey, we invest in teams. Because early on, anyone can have a great idea and anyone can build a business plan that sounds exciting, but most of those companies are going to fail. And so if you just invest in the idea over time, you're going to end up probably losing most of your money. But if you invest in a great team, then maybe their initial idea is going to fail, but eventually that team is going to find success. And the same, in a similar way, and those, and venture capital, those are considered the most exciting investors and some of the smartest investors out there. Whether it's true or not, that's kind of the way they're perceived in most scenarios or portrayed. So in the same way, and the more the quote unquote boring world of Warren Buffett is, okay, we want to find great teams and invest in great teams and have great businesses. And so it very much is that people first type idea. And so let's actually jump down in this next paragraph down here where he talks about the specific things he looks at, and then we'll discuss and kind of wrap up for the day. He says, you will notice that our major equity holdings, he lists the major companies, and we don't need to discuss them now because honestly, probably the only one anyone here listening would even recognize is the Washington Post company, which now is owned by privately owned by Jeff Bezos from Amazon, funny enough. Yeah. So he says, you will notice that our major equity holdings are relatively few. So saying, hey, we've got, how many are there? 1, 2, 4. He's got about 9 companies they own. So it's relatively few because in most cases, people will say a well-diversified portfolio usually has 15 to 20 companies. They've got about 8 or 9. So you'll notice that our major equity holdings are relatively few. We select such investments on a long-term basis, weighing the same factors as would be involved in the purchase of 100% of an operating business. So basically saying we view buying individual stocks in a company on the public markets with the same level of seriousness we would if we're going to buy a company outright privately. And we use the same factors in evaluating them. And here they are. Drum roll, please. Here's what you've been waiting for weeks, David. Here we go.
Here it is.
So it says here, the same factors as would be involved in the purchase of 100% of an operating business. 1, favorable long-term economic characteristics. Okay, are you still awake? It sounds really boring. Okay, let's read through and we'll come back. So favorable long-term economic characteristics, 1. 2, competent and honest management. We talked about that. 3, purchase price, attractive when measured against the yardstick of value to a private owner. So basically, if you're looking to buy this privately, is the public price, like how does it compare to what it would cost to buy it privately? So basically, he's looking at how is it valued? Is it overvalued or undervalued? 4, an industry with which we are familiar and whose long-term business characteristics we feel competent to judge. So, I mean, that's super basic. 1, favorable long-term economic characteristics. So I'm sure that's the business. So basically, the business and the industry that it's in over the long term looks to be favorable. Like we look to see favorable growth over the long term for this company and its industry. 2, competent and honest management. 3, it's value. It's a good price. Basically, it's on sale. We are familiar with the industry and we feel comfortable making judgments about it. So basically, we understand the company and the industry. And you hear that, and again, anyone listening to this who's been investing for any period of time and heard from Warren Buffett or other investors, you've probably heard all that before. But here's the thing is, are you doing it? And I'm sitting here with an investment business, running a podcast, and I'm telling you, I read those things and I'm convicted because I don't do those enough. And, I'm currently reevaluating the rubrics that I use for making investments and building a portfolio. And I'm realizing, like, I'm struggling over certain decisions, what certain companies I want to include, certain companies that I want to, I want to include, but feel like maybe I shouldn't. And I'm looking at, man, if I'd have basic rules like these, it makes it so much more simple.
Yeah, it is. It is funny because, like, I look at all of these and I imagine they all take a good amount of work and research. I think I don't know. It sounds like that's what, again, I think we've talked about it several weeks ago, but just talking about the discipline of it all. It's just Absolutely. So much. I think about, you got one, you have to know, just to know the industry in which it's in. I feel like that's going to take a considerable amount of just research and just, researching every part of that. And then also the long-term economic characteristics, you're only going to know that by the research you put into it and by the history of it. And then obviously their competent and honest management. Again, I think it's just over the course of what they've done and how you can. So I don't know. I look at all of that. I'm like, there's a significant amount of work in each of those. So it's simple enough, but I feel like that was what would scare me away is I'm like, well, you know what? I don't know anything about the industry. I just know it's a good price. So I'm going to enter into it. Or, hey, I know it seems like it's a great industry. I know nothing else about the management or anything like that, but I'm going to go into it. And so I feel like those are all factors that take a considerable amount of work.
Absolutely. Well, and I think and the great thing about what you're saying is it's a very sober approach. It's realizing, hey, I've got major limitations here. And again, like we say on a regular basis about this podcast is, it's kind of like coming to the investment chiropractor. You're going to hear a lot of similar things week to week through here because we need to hear them over and over again. I need to hear them over and over again with all of the experience I have as an investor, all the things that I read, all the things that I study, all of the reports that I read, all the investors that I interview and I talk to. I read this letter and I'm convicted and I'm challenged, even with the basic things that it's sharing that we're talking about here. And that's one of the reasons that I want to share it through the podcast is I know that anyone listening here, regardless of experience level, needs to be reminded of this stuff over and over again. And like you're saying, and it gives us sobriety and realizing, hey, okay, how am I doing? Where are my limitations? And like you're saying, so if you're coming from based upon what you just said, then you're very wisely saying, I'm not ready to start investing on my own yet. I'm not ready to make individual decisions yet on a significant basis. Maybe dip my toe in the water a little bit here and there with a very small amount of money that, you realize you're kind of risking a little bit, but you're much more reliant on outside managers, and you're much more reliant on making very conservative decisions with like passive index funds and things like that, because it's just, you're not making individual stock decisions. Then over time, someone can say, okay, well, I'm going to start researching and learning, and hey, I've learned a lot about this company or this sector. I want to put a little bit of money into it and learn. And then over time, then over a period of years, you realize, hey, I'm getting really confident, and I'm understanding what's going on more and more confident about who you can trust in terms of advice and managers as well.
Yeah, it's definitely, and we've seen it in the letters, but he definitely takes a big account on people. I think that's a huge thing. And obviously, like, you just get into the work and who's managing it and how is it working. And so I don't know. It reminds me of I think it's a Jim Collins book, The Good to Great book, where he's just talking about getting the right people on the right bus and talking about getting the people. It just kind of like,
exactly.
It reminds me of a lot of that principle.
Exactly. Get the right people on the bus and the wrong people off the bus, and then let them figure it out.
Right. And so I think and again, it's part of it's let them manage, but you trust in that. You trust in the honest management, as he was saying, competent, honest management, and then let them do their thing, let them manage well, because then that's going to help. I feel like that's when you trust the companies, you let them manage it.
Right.
So.
And again, to wrap things up, because he's going to mention these dynamics again in the 77 letter next week, and so I want to discuss it more there as well. So we don't have to exhaust it today. But again, I think for me, I'm seeing more and more, even as an individual investor, that not only is me having a good glimpse of the management of the companies that I invest in is important, but me picking good investment managers to guide my investing decisions is probably one of the most important decisions that I can make. So with that, we will pick this up next week. David, always a pleasure. And everyone, thanks for listening. It's great to have you. We love sharing the show with you. And again, you can visit us at investorinthefamily.com for old podcasts or any other updates from the company. And we'll see you next week. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.